Uh, I'm Brad Cook. For those of you who don't know me, I'm the founder and chairman of Endeavour Silver Corp, a longtime member of the Silver Institute. And on behalf of the Silver Institute and its members and supporters, it's a pleasure for me to welcome you to today's briefing on the Institute's annual report, the World Silver Survey. Considered by many to be the most consistent report on the global silver market published each year. In addition to our guests here in New York, I also want to welcome the many listeners on our live audiocast of today's presentation. Before we begin, I want to express our gratitude to all the Silver Institute member companies and the World Silver Survey sponsors for your generous support of our work, making events like today possible. I also want to recognize my colleagues from the Silver Institute Executive Committee who are attending here today. Phil Baker is here, Paul Healy is here. I saw Mike Steinman last night, but I don't think he's coming today. So thank you, guys. Oh, you made it. Fantastic. Helping us understand what transpired in last year's silver market and what we might expect as we move through this year are our two presenters today, Philip Newman, the Managing Director of Metals Focus, and Adam Webb, the consultancy's Director of Mine Supply. Metals Focus, the independent precious metals research house, has a team of 30 professionals and consultants with 8 offices worldwide. Their firm produced the 2022 edition of World Silver Survey, now available for download on our website at no cost, silverinstitute.org. Following the presentation, Philip and Adam would be happy to take your questions. Raise your hand in the audience to ask a question, and for those online, if you'd like to submit a question, you'll find the Action Center in the lower right corner of your screen. You can submit a question using the Q&A section, and you can do this at any time during the presentation. After the presentation, our CEO, Mike DiRienzo, the Institute's Executive Director, will ask Philip or Adam to answer on your behalf. So we hope to get to all the questions, time permitting, after we hear from Philip and Adam. For the 2022 edition, there's 23 companies from around the globe that made this publication possible through their financial support. And on behalf of the Silver Institute, I'd personally like to thank them for their generosity. The membership includes Coeur Mining, Fresnillo, Industria Españoles, Pan American Silver, Silver Wheaton, and the sponsors of today's event, Beijing GNS Digital, Minas Buenaventura, Dillon Gage Metals, Endeavour Silver, Hecla Mining, Arias Metals, Hochschild Mining, KGHM Polska, MKS Pump, Silvercorp Metals, Sprott Physical Silver Trust, and TD Securities. Our contributors are Asahi Refining, CIBC Capital Markets, Gatos Silver, International Depository Services Group, Tanaka KK, and Valcombi. I would also like to mention before closing that notwithstanding COVID, we've actually been growing the Silver Institute membership. I think we're up by 7 members and 5 sponsors in the last 2 years. So thank you for all your support. And now let's turn this over to Philip and Adam. Gentlemen.
Thank you. Well, thank you, Brad, and good morning, everyone. As much as we've certainly enjoyed the webinars of the past couple of years, there's certainly no substitute for actually being back in New York, so it's very good to be here. First of all, importantly, we'd also like to, on behalf of Metals Focus, thank first of all the major sponsors and also the sponsors and contributors. And to be blunt, without your support, without their support, it wouldn't be possible to produce the Silver Survey. So let's crack on. So over the next few minutes, as Brad said, myself and Adam will give you a review of 2021 in terms of the key drivers of the price, investment, supply and demand. And then we'll finish up with some comments on the outlook for 2022. So this chart, which will be familiar to all of you in terms of the trends in gold, silver prices over the past couple of years or so. And really, from my point of view, the one key takeaway is the fact that silver, which established and moved into a higher trading range in really the summer of 2020, and the fact that it sort of held in that level, was held in that level overall through to the present day. If I now sort of just take the same chart, shorter time horizon, and we've thrown on here just a few key events, certainly by no means exhaustive. And in fact, if you get a chance in the Silver Survey in Chapter 1, we have an events chart which goes to a lot more granularity in terms of the events. But we wanted to pick out just a couple for the moment. So working across the Reddit squeeze, which now seems perhaps a distant memory. And although at the time, in terms of price action, its impact was really very short-lived, as you can see from the price spike, it certainly resonated and was incredibly successful in terms of the impact on silver investments, be it bar and coins, mining equities, and ETFs as well. And we'll come to all of those later on. Moving on, again, we see the impact on silver in terms of acting as a precious metal, but also as an industrial metal as well. So, for example, the impact of those hawkish Fed comments as inflation surged, what that meant in terms of the potential outlook or growing concerns for the global economy. And that certainly has weighed on silver. And you can see that to an extent on the right-hand side. When we had the invasion of Ukraine, there was certainly safe haven buying of silver and gold. But you can certainly see how gold has outpaced silver. And that comes through when we look at this in terms of the gold-silver ratio. Now, of course, the ratio is far lower than we saw in early 2020, when we hit a record level of about 127. But you can also see how that ratio is held in either the high 70s or the low 80s very recently. And then if we look at that on the longer term horizon, that ratio you can see on the far right-hand side, therefore holding above that ratio. It's about 69 over this time period. But I would say to you, that in itself wouldn't be a reason why perhaps silver should strengthen. But again, we'll come to some of the drivers later on in terms of our views for the prices in 2022. And just to finish up with a couple of slides on some of the key investment areas before I hand over to Adam. Firstly, again, a comparison of gold and silver. So here we're looking at net positioning. We've indexed at the beginning of 2020. So clearly a volatile area. That's not really saying anything new that none of you are particularly unaware of. But what we do see for 2021, how a very different, I guess, overall trend for institutional activity versus retail, as broad as that landscape is. So if we looked at the net positioning comparing the beginning of 2021 with the end of the year, it was down about 140 million ounces. Of course, as you would expect, in terms of that safe haven buying that we've seen over the past couple of months or so, both have strengthened considerably. We look at the ETF position, again indexing to the beginning of 2020. You see a slightly different pattern. Again, what stands out is that spike around the time of Reddit. But I think what was very encouraging is that although ETF buying spiked, the liquidations that we saw were very modest. And although buying after that, we've seen through to now, hasn't done a tremendous amount, I think it's very encouraging that those holdings are holding really close to record levels. Incidentally, for gold, that's actually hit a record high. So what I want to do now is hand over to Adam, and then I'll be back later to talk through the various areas of demand.
Thanks, Philip. So, moving on to mine supply now. So, global silver mine supply increased by 5.3% year on year in 2021. So that brought it up to 822.6 million ounces, which is a rise of just below 42 million ounces compared to the previous year. So what caused this increase? Well, if you recall, obviously the COVID-19 pandemic began in 2020, and what that led to was governments enacting policies which required mines to temporarily halt production. And this was on a country and a regional scale. So we saw a big drop in decline in 2020. Now, what we had last year was the pandemic was ongoing, but that disruption was more at an individual mine level. So you might have disruption at an individual mine, but not on a country or regional level. So therefore, you had a rebound in output. So for example, in Mexico, output dropped by 4% in 2020. In Peru, it was down by 25%. In Bolivia, 19%. But as you can see on this map, in Mexico, output was up by 9% last year. In Peru, up by 6%, and Bolivia by 39%. Now, we did have reductions elsewhere, so for instance, Russia, Kazakhstan, Chile, but overall, global production was up. So just looking at this more on a regional scale now and a time trend, that 5.3% increase was actually the biggest since 2013, which you can see in this chart here, the comparison there. And regionally, unsurprisingly perhaps, given what I've just said, the biggest increases came from those regions that were most heavily disrupted by COVID-19 in 2020. So for instance, in Central and South America, output dropped by 16% in 2020. It was then up by 8% last year. In North America, output fell by 5% in 2020 and then was up by 8% last year. In Asia, we had a 5% increase. That was partly due to the rebound from China, where output was disrupted in early 2020, but also the ramp up of Grasberg in Indonesia. That mine is continuing to ramp up production, and it's a significant silver producer alongside gold and copper. Now, elsewhere, we did see declines. So in Oceania, there was lower output. That was largely due to a drop in production from Papua New Guinea. And in CIS, as I mentioned, Russia and Kazakhstan, output was lower, therefore that dropped. And if we look at this chart on the right, this shows the top 10 producing countries in 2021. And you can see Mexico is by far and away the biggest producer still. It produced 197.6 million ounces last year. And that was actually the biggest output for Mexico in our records going back to 2010. Now, what we're expecting from Mexico this year is for that to surpass 200 million ounces, but I'll talk a bit more about that later. And then in second place now, we have China, and that's actually more to do with a drop in output from Peru. So in Peru, silver production has been declining since 2017. Now, there was that rebound last year, but that drop over that time scale has allowed China to move up to second position. So now moving on to look at production from source type, silver production increased from every source in 2021. So silver is produced as a primary product from silver mines, obviously, but also as a byproduct from mines producing primarily other metals. So for instance, lead, zinc, copper and gold mines. Now the biggest increase came in primary silver mines, so you can see that here. So that was a 10.2% increase year on year. And that was due to the location of primary silver mines. Many of them are located in countries that were heavily disrupted by COVID in the previous year. So as I mentioned, Mexico, Peru, Bolivia. Now, conversely, the smallest increase came from silver production from copper mines, which you can see here, that was 0.7%. That was largely due to lower production from Chile. So silver output from Codelco fell, also Escondido, which is the biggest copper mine in the world. Then for lead zinc, there was a 5% increase. For gold, 6%. So that kind of concludes the section on 2021 production. So I'll now move on to talk about a few other areas of mine supply. So I'll start with ESG. So ESG has been a really hot topic in recent years. So that's environmental, social and governance issues. So I was at the Mines and Money conference in London in November, and literally every presentation had an aspect of ESG within it. And it's really become more relevant for the mining industry as a whole. Although having said that, it has been very important for miners for a long time. So failure to comply with any of these environment, social, governance issues is a real risk to mining operations, as in they could be closed down, etc. So that's a material risk to cash flow. So miners have been on top of this for a long time, but there's been a real increase in focus on greenhouse gas emissions, or GHG, and that's because of their link to human-induced climate change. Now, there are two factors that influence GHG emissions for miners, and that is the source of the energy and the amount of energy being consumed. And we can see from this chart on the right, the biggest source of energy for primary silver miners in 2020 was diesel at 58%. And that is for mining equipment, but also for on-site electricity generation using diesel generators. Now we can see that renewable energy accounted for 16% of energy consumption for primary silver miners. And we can expect that to increase going forward, I think. For example, Fresnillo have said that they're planning to source 75% of their electricity from wind turbines by the year 2030. And other producers are looking at similar things to reduce their greenhouse gas emissions. Now, having said that, looking at this chart on the right, the grey bars are showing greenhouse gas emissions per ounce of silver produced for primary silver miners, otherwise known as greenhouse gas emission intensity of production. Now that's actually increased by 19% from 2016 to 2020. And that's perhaps surprising given what I've just said. So what has caused that increase? Well, if we look at the brown bars, that is greenhouse gas emissions per tonne of ore processed. And that's actually fallen by 3% over the same time period. And that's from the same group of mines. So what is actually causing that increase in intensity is not an increase in absolute emissions, it's the change in grade of the ore being processed. So that's actually fallen, the grade has fallen by 23% over that same time period. So moving forward, I think we can expect to see absolute emissions falling, but if we're looking at things like intensity of silver production, we always have to take into account that the grade or the characteristics of the ore body, because that's going to have a significant influence. Moving on to costs, it may surprise some people here to hear that costs for primary silver miners actually fell in 2021. And that is despite the inflation we're seeing in all sorts of costs, so fuel, electricity, consumables, labour. And coinciding with that fall in costs, we had a rise in the silver price. And that led primary silver miners' margins reaching their highest level since 2012, which we can see here. So total cash costs fell by 18%, all-in sustaining costs were down by 3% year on year. The silver price was up by 22% year on year. And what that led to was miners' margins actually reaching more than 3 times what they were in 2019 by last year. So what has caused this drop in costs, given the kind of inflationary cost environment we find ourselves in? Well, it's these, so higher byproduct credits. So it's to do with the way that we look at costs for primary silver miners. We basically are looking at them on a byproduct basis. So what that means is all the costs are allocated to silver. You then net off the revenue of the byproduct metals. So that's gold, copper, lead, and zinc. And you can see from this chart that from the start of 2020 to the end of 2021, the price of those 4 metals increased significantly. So copper was up 58%, zinc 57%, lead 22%, and gold 21%. And what that led to was an increase in byproduct credits to record highs. And primarily that came from an increase in zinc revenues. So what we actually saw, if you ignore the byproduct credits, costs on the mine site actually increased by 18% year on year. But these credits increased by 20%. Therefore, the net of that led to a drop in byproduct costs for primary silver miners. So just thinking about this year, the price of those metals is remaining strong at the moment. But if we see those dropping off, then we may see a return to costs on a byproduct basis increasing. It's just whether the price of those metals outstrips inflation in input costs, basically. So moving on to primary silver mines reserves, they fell by 4% year on year, which you can see in the chart on the right. And that was just a factor of mining depletion of reserves outstripping additions from exploration and engineering changes. So, for example, Fresnillo's reserves fell by 38 million ounces. That was just a result of production depletion at San Julian, mines such as San Julian, Saucito, amongst others. Now, this chart on the right shows M&A activity in the primary silver sector. And we can see down here that the number in 2021 was extremely low. That was actually the lowest it's been since 2006, $11 million. And that is perhaps surprising given what I've just said about high margins. Producer balance sheets are generally pretty strong. So you would think that M&A activity might be quite robust. And actually, this is quite deceptive. This is just primary silver production. So what we did see is M&A activity from primary silver producers aimed at diversifying into other metals. So the biggest example of that was the $759 million deal from Fortuna Silver for Roxgold for their gold assets in West Africa. So this year it will be an interesting one to keep an eye on. Again, margins look like they're going to remain high. Producers are in a good position, debt levels are generally relatively low, but whether that will be targeted at primary silver producers or diversifying, that's just down to individual company strategy, so something to keep an eye on. Moving on to hedging. So hedged production actually fell by 23% year on year and actually fell to very similar levels to what it was in 2019 following an increase in 2020. Now, that drop would have been bigger, but we had additions to the hedge books of Peñoles and Hochschild during the year, quite significant. So that caused the drop to be lower than otherwise it would have been. And this chart on the right shows silver production covered by hedging and streaming and royalty deals. And that actually reached its highest level on record in 2021. So what caused this was some of what I mentioned earlier, so the recovery from COVID-19, but also additions to these companies' portfolios and new projects ramping up that had streaming deals on them. So, for example, Wheaton Precious Metals added 3.3 million ounces year on year, and that accounted for about half of that increase. And that was from the addition of Marmato and Cozamin to their portfolio, as well as the recovery from COVID-19. Outside of that, we had the ramp-up of Cobre Panama, which Franco-Nevada has a stream on. We also had the ramp-up of Buritica in Colombia, which Triple Flag has a stream on. So it'll be interesting to see what happens this year, whether that rising trend continues, because with increased interest rates, increasing capital costs for projects, streaming deals may remain an attractive source of capital. But offsetting that, high margins, low debt levels, strong cash positions for companies may mean that there's less need for streaming. So I'll be interested to see what happens with that this year. And for my final slide, this is our outlook for 2022. So what we're expecting is a 2.5% year-on-year rise in silver production to 843.2 million ounces. And you can see clearly from this chart that primarily that will come from North America at almost 20 million ounces. That will mostly come from Mexico, where we're expecting 16 million ounce rise. And that is a combination of new and recently commissioned projects increasing production. So Cerro Los Gatos, for example, Juanicipio, but also established mines. So for instance, Penasquito, The grades are expected to increase based on the mine plan, and that will add additional ounces. Outside of that, we've got La Cuapa project in Chile, which is a gold mine, but high silver content. That came online earlier this year. And then the Udican copper project in Russia, which obviously is primarily copper, but will produce a lot of silver as well. Now, the final thing to keep an eye on this year, fairly obviously, is the Ukraine-Russia conflict. Now, what we've seen so far is the suspension of Kupol, which is one of Kinross's gold mines in Russia, but that produced 3.3 million ounces last year. Now, they've agreed a deal to sell that mine, but it's obviously going to have an impact on production because it's currently suspended. Outside of that, the sanctions mean that anyone operating in Russia will have difficulty, obviously, accessing finance, but also accessing equipment. So that could influence production further this year and moving further forward. And Russia is, as you saw earlier, a top 10 producer, produced 39 million ounces last year, so something to keep an eye on, I think, this year. And with that, I will finish and hand back to Philip.
Great. Thank you very much, Adam. So really bringing that all together, go backwards one. So this is our snapshot of supply for last year compared to 2020. Adam's obviously already spoken about mine production. I'm not going to talk about anything else on here, but if there's anything of interest in the Q&A, please do raise that if that's of interest. But you can see here for global supply last year, up around 5% to very close to 1 billion ounces. But as we now see, that was eclipsed by what we saw on the demand side. And that is, I think, one of the factors why the market was so tight, or has been tight, especially in the likes of the US and Europe as well, in terms of the premiums we're seeing on 4.9 silver, and also, for example, in the physical investment space as well. But first of all, just looking at some of the key areas, and one of the real protagonists for that strong performance was a record total that we saw for industrial demand last year, up 9%, eclipsing 500 million ounces in 2021. So as you can see, not only did we recover from what was happening in terms of COVID in 2020, we surpassed that as well. And there were a whole range of reasons for that. We think about the consumer electronics, people working from home, all the kits that you had to buy, perhaps your children were, at school. I know my son has now more IT than I ever had. So, but this was happening, of course, globally. So this was certainly, I think, a key development. One of the other key areas we saw was in the solar or photovoltaic market, where we saw a record total. In fact, as you can see, we've had successive record highs in terms of new installations, which is shown by the green bar. In terms of actual silver demand, that rose by about 13% to about 114 million ounces last year. Something else I want to highlight is shown by the line, which is an index of silver loadings that we see. One of our charts we do show quite often, but I think it's very relevant. Now, although, of course, you can see on the far left-hand side, the reaction when prices hit $40, $50, how the industry aggressively tried to reduce the amount of silver. But I think what was also very telling is that around 2014 and 2015 and 16, when prices were really relatively depressed, averaging below $20 an ounce for several years, that we still saw the thrifting continue, and it's still continuing today. So in terms of trying to look at the relationship between installations and silver, what I wanted to do is just strip out that steep decline and look at the more gentle decline that we've had since 13 through to now. So we can see that installations over that period risen by 300%, but average loadings in terms of silver content have fallen by 45. Even so, we've seen silver demand therefore rising by over 100%. But I think it's important just not to think that when we're looking at what the trend is in gigawatts is not a straight linear relationship to the contained silver. Away from that and packaging this slightly differently, and the reason I wanted to include slides perhaps at the country level is just to think about, as I said, the tightness that we've seen in parts of the market. Now, although I mentioned that the US and parts of Western Europe are especially tight, and as you can quite clearly see, Europe isn't shown on this slide, Europe is still supplying silver to some of these key markets, especially the likes of the US and India. And so there are different ways you can slice and dice this. And what I wanted to do with this first one is just to look at some of the core underlying areas of demand to give a sense of how they've recovered in terms of COVID. So this therefore excludes coin and bar, which is exceptionally volatile. Very important, as we'll soon see, but that can be quite volatile. So you can see here, the US really leading the charge in terms of the recovery post-COVID, especially because of very strong industrial demand. China also getting back up there almost. Japan as well. India, quite different, really impacted because of record prices that we saw in rupee terms. And I think also this performance is perhaps all the more impressive given the chip shortage that we've seen that shows no sign of slowing for the time being as well. So if we now expand this same slide, it includes the all-important coin and bar market. Now you can see here we move from a ceiling of 150 up to 250. And so now you can see the impact of coin and bar and perhaps getting a better idea just why the markets are so tight, and as I said, especially in the likes of the US. What immediately also jumps out at you is that the Chinese and Japanese numbers haven't really moved. These markets really are not that important in terms of physical investment, coin and bars. Much more for gold, not really for silver. You can also see much better recovery for India, but the market in 2020 was really hit very strongly. When prices really spiked, a lot of selling back, so a lot of disinvestment, and that really depressed the 2020 total. Going on to jewellery and silverware, looking at it slightly differently. And again, I wanted to really stay with the theme of India, given how important it is to these two areas. You can see there in terms of the top one for jewellery, how well markets outside India have done, the likes of the US itself, Thailand, to name but two. But you can see also the fact that that recovery in India, that partial recovery, which really ties into that previous slide. Silverware, a much smaller market, of course. But again, you can see this partial recovery in India as well. But I also wanted to do is just highlight how the rupee price has contrasted with the dollar price. So the top one, as you can see, dollars per ounce. The bottom one is rupees per kilo in thousands. Now, interestingly, prices actually hit a record high in 2020, not last year. It took me a while to get my head around this. But what we've seen is that prices have moved to a higher level in 2021. They just didn't reach that spike that we saw in 2020. And this is a key reason why, yes, we've seen a partial recovery in India from COVID, from the ongoing lockdowns that we've seen there. But as again, with those prices being so high, that has certainly held back the market. So when we think about going forward, there is the potential for India to recover more. And in fact, speaking to my colleague in Mumbai this morning, it's, as we've seen so many price-sensitive locations, it's about price volatility, sometimes more than price levels. So with prices holding roughly in this area, consumers can gradually adjust to these levels. So moving on to the all-important bar and coin, perhaps a star of last year, and continuing to strength this year as well. So much going on here. Start with the US. As you can see, getting back to the highs that we saw in 2015, market, bullion coins and allocation, shortages of products, eye-watering premiums that showed no sign of abating, very little selling back, so basically it's like a one-way market. And that's really continued this year as well. I think what was interesting for the US is that actually in January last year, the market was actually a little slow. But when the Reddits kicked off, then really, I think, all hell broke loose in manner of speaking. And as one of my contacts described it, since then, demand has been really relentless. It hasn't slowed down almost at all. Of course, you had other wrinkles. You had the US Mint moving from its Type 1 to its Type 2, which caused a bit of a wrinkle in the middle of last year. But really, the market has been exceptionally strong. And in fact, you can see the reason we didn't get back to, say, a record high was because of how weak the Indian figure is. Just compare it to these, really. So you can see how it almost disappeared last year, sorry, in 2020 rather. Germany, another strong one. One of the key markets there has been Australia, which has really burst into life over the past 2.5, 3 years or so, past 2 years or so. But you can get a sense just of how important this area of the market is. And as I said, early 2022, still exceptionally strong. Staying with the US, and this is now broadening it, we're looking at bullion imports. I'm really trying to continue the theme of the tightness in the market and the sources of silver that we've seen. So as I said, this is not just about an investment, because clearly we have good delivery metal from Korea, Poland, Canada, and of course Mexico. Perhaps a slightly unusual one that's popped up over the past couple of years, Turkey, as you can see here in 2021. We also had a lot of investment product. So I'm not talking about 1,000 ounces, I'm talking about 100 ounces and below, coming in from the likes of Australia, from Switzerland as well. Whereas the Swiss flow here was much more about the EFP crisis that we saw. Whereas, as my understanding is, for 2021, this switched to being largely an investment product. So some really interesting developments in the market last year. Just a couple of other comments. Just thinking about metal coming in from Russia. This is directly from Russia. Again, the theme of the market being tight. So you can see here, last year, 5.5 million ounces imported directly. That may not happen again anytime soon. And the Jan to Feb total is not Russia, that is total US imports over the first 2 months, down 30%, which I was frankly quite surprised about. Now, it's been very careful about reading too much into 2 months of data. But given how strong things have been, and given the tightness in the market, and obviously one has to allow for tremendous logistical issues in getting metal over. Putting metal out of the likes of London has become more challenging for various reasons as well. You think about the elevated costs of shipping, but even so, I still find that quite surprising. So anyway, wrapping that all up, for last year, we had global demand up 19%. Of course, that did relate to the recovery partly from COVID, but even so, that outpaced the growth that we saw in supply. And so you ended up with, by our figures, a deficit, the largest one in our numbers. Our series goes back to 2010. Now that, I think, is quite telling. I think we just need to put that into context. We're looking at a deficit of around 50 million ounces out of global demand of 1 billion ounces. So I think we just need to just pause and just not, it's a very, I think, interesting development, and we'll see what that means also for 2022 and forward and further out in a moment as well. So for global supply, so Adam's already talked about what we've seen or what we'd like to see for mine supply for this year. Looking at a 6-year high, rising by 3% to just over 1.03 billion ounces. And what we'll see, though, is, when it comes to demand, is the strength, the ongoing strength in that market. So just carrying on with the slide I showed earlier, this is the totality, so including coins and bars again. but you can see overall the strength we see in China, Japan, and India. The US, potentially down slightly. This has been quite a bit of debate between me and quite a few of my contacts this week. It just seems challenging to me that we will see further upside in the coin and bar market, just given the scale that we've seen in the past 2 years. So is there the potential for a slight dip? Possibly. If it happens, it will be extremely modest. But time will tell as we go through this year where we end up for 2022. But overall, we have strong performance again for global demand this year, 5%, a new record high. So once more, eclipsing the performance of supply. And therefore, we end up with another deficit, a larger deficit, in our view, for 2022. Perhaps more important, and though this next one won't surprise any of you that take our 5-year silver forecast, but we think that we are into a period, at least for the foreseeable future, of ongoing structural deficits in the silver market. So I think that's certainly one of the most notable changes, understandably, that we've seen for quite some time. So changing tack slightly, and just to finish up before we take some questions, where do we see prices heading for this year? So clearly what we're seeing at the moment, there is certainly and understandably, for want of a better phrase, a war premium to both gold and silver. And of course, when we're thinking about the outlook for silver prices, we can't do so without thinking about gold. But in our view, and we certainly would not pretend to call it when this will happen, but at some point in the coming months, the focus of, primarily we're talking about institutional investors, will gradually shift to focus very much more on the macro outlook and the macro backdrop. And therefore, in terms of where does inflation sit, and therefore what does that mean for interest rates and therefore the economic outlook. For silver, though, what's interesting quite specifically, again, we're trying to think of the dynamics, the interplay between acting as a precious metal and as an industrial metal. Of course, it's neither one or the other. It's always going to be a mixture, obviously. But it was interesting here to look at how silver has, let's get this to work here, how silver has behaved much more as a precious metal as you would expect, given I mentioned that war premium that we're seeing, and therefore that breakdown, at least for the time being, between silver and global bonds. Having said that, the link between silver and global manufacturing is certainly there. And I think this is one of I touched on this earlier. This, I think, is perhaps the key element or driver, while silver has, to some extent, underperformed gold in recent months, and why that ratio has remained stubbornly high in the high 70s that I touched upon. And so, ultimately, to finish with our last two slides before myself and Adam take your questions, in our view, what we see happening in terms of the dynamics, the transitioning this year is, as I said a moment ago, investors gradually, at some point, shifting their focus from what's happening in the Ukraine to thinking about the macro outlook. And so, in our view, there is the potential for the expectations of how the Fed will behave from a rate policy standpoint to perhaps be overdone, maybe even the potential for a policy mistake. And so we think that initially rate increases may not be as aggressive as are currently being laid out. And if that comes to fruition, we think that will lend support to both gold and silver prices. But then as we gradually move through the back end of this year, in our view, rate increases that will come through, the impact of those will be amplified by an eventual drop in inflation, which we think will occur, potentially perhaps because of a correction in energy prices. The impact those dynamics will have on real yields as well, and hence why we have a slightly softer tone towards the back end of this year, as professional investors start to liquidate some positions. I say some because this certainly won't be a one-way trend. We expect other institutional investors to look at that, view that as a bargain hunting opportunity, so that I think there'll be a lot more sort of two-way activity, but net, we think this will gradually weigh on prices. And then so to finish up, we think therefore you'll see a broadly similar trend to silver, again with a slightly weaker tone to the back end of this year. And so in terms of the annual average, dipping slightly, but as I said in the very beginning of the presentation, we just have to put into context the strength that we've seen in silver over the past 2 years, coming from an extended period of sub-20 prices on an annual average. So although we are dipping potentially by 5%, taking a step back, prices still remain strong in absolute terms and historical terms. And on that note, I'd be happy, myself and Adam, to take any questions that you may have. Thank you. Just a quick microphone. Okay, thanks.
This is a question on supply out of Russia. I can't recall the number from last year. It was 39 million ounces, something like that.
Correct, yeah.
Do we know where that metal comes from? What's the split between doré and concentrate? Is it actually treated in country or shipped out of country? And assuming it's out of country, doesn't that imply that there's going to be some sort of squeeze at the refiner and smelter level?
Yeah, so I don't know off the top of my head the exact split between doré and concentrate, but I can share that with you afterwards. Doré would remain in country. Generally, it's not allowed to be exported from Russia, so that remains in country, but some of that production will obviously be in concentrate. Precisely where that goes, some of it will remain in country, some will go to China, some Kazakhstan. For example, Polymetal have announced they were exploring the option of treating all of, or as much as they could, their concentrate production in Kazakhstan, but they're still exploring that option. And they have said currently that they can provide their product to all of their customers, and they obviously have the biggest primary silver mine in Russia, Dukat. So hopefully that answers the question, or partially.
I'm trying to figure out if you're bullish or bearish on mine supply. You talk about ESG pressures, which are huge. You talk about reserves falling at mines. Yet in your presentation, you talk about production being at a 6-year high this year. Then you talk about the persistent deficits going forwards. So Jeff Curry of Goldman's is talking about shortages of everything. And so my perception looking at the chart is that this is a dead cat bounce in supply this year, and the trend is likely lower. But I'd be interested in your view on that.
Yeah, I mean, in terms of mine supply, I mean, the deficit is obviously to do with the demand side as well, which I think Philip can talk to a bit, perhaps. In terms of the mine supply, I wouldn't say bearish or bullish, but yeah, we're expecting that increase. I mean, that is coming from the projects currently in play. Obviously, it takes a long time to develop a mining project. It's not like they can just switch on or off. Something else to take into account, which we have taken into account in that forecast, is mines such as my favorite one to pronounce, Uchucchacua in Peru, which is the biggest primary silver mine in Peru, and they Buenaventura suspended operations temporarily late last year. So that's taken into account there as well. I mean, I think the thing to keep in mind is Russia. That's a risk to that forecast. If those sanctions lead to further mine closures, so for instance, in the gold space, we've seen Petropavlos look to sell some of their mining assets because of the sanctions, and whether we see some of that spill over into silver as well, that could potentially see that forecast falling. So that's where we stand on the mine supply side, but Philip, I don't know if you want to add for the deficit and the demand side of that equation.
I think in terms of whether we're bullish or bearish, I think there's a number of different parts to it. So from a demand outlook perspective, looking beyond to 2022 and further out, yes, we are pretty bullish, there's no doubt about it. I think that's reflected in the fact we have that structural deficit going on. If you're thinking from a price standpoint, I think it's a slightly different dynamic, because if you move further out and for longer term and you're perhaps in a more benign macro backdrop, then that maybe is a harder case to make for an institutional investor, and so that could certainly weigh on prices. So you could certainly have a longer term dynamic of perhaps a slightly weaker tone to prices, and yet still have structural deficits.
I was intrigued by your commentary on the value of byproduct credits / primary production in some cases. I remember in my working days, I was looking at Grupo Mexico at one stage, and when the copper price was weak, they focused on the higher silver portions of the pit. And now that copper is pretty strong, you may well see some sort of retreat away from the higher silver portions. I don't know if you take that into account, but I just wonder on, primarily what's your confidence level in terms of the increase in production of silver that you're forecasting for this year?
Yeah, I would say I'm quite confident. There are those risks, like I say, Russia. In terms of targeting higher grade areas, I mean, the silver price is also strong. So, and it's not often with many operations, it's not as easy just to simply switch straight away. It takes time, it has to incorporate into a mine plan. Sometimes you might have a stockpile of high grade material with a certain metal which you can put through the process plant, but that kind of flexibility is limited, I would say. So I don't foresee a switch to concentrating on the base metals. A lot of the time as well, it's all incorporated into the same material. So it's kind of difficult in many deposits to be that selective in which metal you're going for. Some deposits, yes, you can do that, but not everywhere. So I'm pretty confident in our forecast.
Just on the price charts that you put up on gold and silver, maybe you could walk through the argument why prices roll over in the second half. Is it financial players or official players that are selling? And secondly, maybe somewhat related, why I don't see why that forecast would hold, and I know there are a number of producers in this room. I've not seen a single mine come on in the last 2 years that the CapEx and OpEx haven't been far upside of their expectations. So prices are going up. The cost price is going up. So do you think there's that much of a margin that price is going to compress that much, that the financial players that are selling, that you're saying are selling, are going to push it down below that price? And then related to that, I guess I'm wondering, to what point, where do you see that? Where do you see the bulk of that selling pressure coming from in your forecast, both for silver, I guess, in particular?
Okay, so to try and dissect that. So in terms of the selling that will come, I mean, when you say official, are you talking about from selling from central banks? Is that what you're referring to from a gold point of view when you're for official?
Or inventories. We've always seen that selling comes from inventories that are held in unnamed sources, so that could be official sources. I guess I'm wondering where you see that selling.
So we would say that selling would be concentrated, as I said, amongst institutional investors, either from a futures point of view or maybe from the OTC. I'm not necessarily expecting to see, be it gold or silver, a depletion of inventories that we're not necessarily aware of. So we think of, will we see a movement out of local London? No, I don't think that whatsoever. So I think it will certainly be from, as I said, if you look from one of my early charts, when we had the chart of the futures position with the net managed money, it will be the likes of those investors, the hedge funds, those institutional players, where the selling will be concentrated. So that's part of your question. Before we come to Rishi, was there was a part of the question about the margins for the miners you're asking about?
Yeah, I was asking about how do you layer in the cost inflation that's happened?
Okay.
Yep.
CapEx and OpEx into your forecasting, both short-term and medium-term?
Yeah, so I think it comes back to that chart I showed. So you're exactly right. The cost, CapEx, OpEx is all increasing. But if you look at the margins last year, they were high, the highest since 2012. So if you're thinking of the cost curve, the price of silver, there wasn't many operations that were in the 90th percentile or above the price. So because the price has been high, the margins have been good, there isn't that pressure yet where you're going to see operations closing. If those costs obviously keep going up and the price comes down, then yes, you would see that pressure. At the prices Philip presented, we don't see that happening yet, but further into our forecast, in our 5-year forecast, we do see that effect coming into play. So that would cause some production to drop off. But the thing to remember with silver production is that 70% of it comes from as a byproduct, so copper, lead, zinc mines, gold mines. And the economics of those mines, they're more dictated by those metals, the primary metals, rather than just the silver. So it's a slightly more complex dynamic in terms of the costs and the influence on price there.
Yours will be more intelligent. I'm not so sure. Hello, Bart Malik, TD Securities. Beyond the next several years, do you actually see capital investment in the primary and secondary mining sector to kind of guarantee us growth in supply? I certainly don't see the appetite. I do acknowledge that some of the smelters, particularly in Europe, may be turned on again. We will probably get over COVID eventually, and those facilities that were shuttered will come back. But beyond that, projects that have been funded and approved, I'm not really seeing a lot in the pipeline. And I'd like to make a quick comment on who's going to be selling. 40% of all flow that we see is CTAs. And why do they sell? Well, just because that's what the program does. You see, spreads off 10s move higher and they sell. You see, the systematic traders tend to behave very Pavlovian, and sometimes they have no idea that what silver is, what it does, or what cost curves do. They just trade. And I think, if rates go up, prices will respond. And that's all. Thank you.
Yeah, I think it's a good comment on the capital deployment for projects, particularly for primary silver. So I think that the thing that we've seen, since the last bull market, and this isn't just silver, this is gold, most other metals as well, in the mining sector, is that during that period, so we're talking, 2011, 12, the run up to that, there was a lot of capital deployment for projects just trying to maximize production. That's what many companies were aimed at. And when the prices came off then in kind of 13, 14, we saw a lot of impairments, and that obviously damaged those companies. So what we've seen from that point is a lot more discipline around capital expenditure. So most companies are now, or have been, targeting, the best projects, so the highest margin, maximizing that value from their investments. And I don't see that changing at the moment. I don't see a return to that trying to maximize production, even if the project is marginal. We don't see much of that, and that has naturally limited the project pipeline. For primary silver, yeah, there's a fairly limited project pipeline, I would say, moving beyond kind of 3, 4, 5 years. But having said that, within that time period, if that changes and prices remain strong, you could see that change and those projects then becoming funded. Obviously, it takes time for those to come in. It takes, anywhere upwards beyond 5 years to construct a mine. So that comes into our longer term thinking, not into next year. But yes, it is an issue, not just for silver, but for other commodities as well.
I'm going to delay Jim for one more second and ask you if you're witnessing any engineering price increases, the planning price that corporates have.
Yeah.
To, an assumed price.
In the reserve calculations.
That's right.
Yeah.
But they're given internal rate of return. Are you seeing those prices change, or remain static?
In terms of the price assumptions in reserve calculations, yes, we have seen it. Not widespread, not everyone, but certainly we've seen it increase, again, not just for silver, but for gold as well.
Really splendid presentation as usual. Really great. Just a quick question. That 3.5 and 5.5 million ounces coming out of, was that to the US? Just a quick one on that. And are we going to see any alleviation in the 4/9 tightness going forward? And am I missing something, or is this an issue at the refining level? Because above ground stocks are not, are ample enough. And so I've always been a little confused about why we're not getting more of the high grade stuff into the market.
So I would say that the 4/9s, the premiums where they are, I mean, will they come down slightly given how elevated they are? That's possible. But if you take a step back and think of the market dynamics, there seems no reason why that would change anytime soon whatsoever. You're having a significant pinch point. The demand is not just for full, but is just generally just so strong. There's no, I guess, let up in any one element. And it takes time to move metal across. It takes time to upgrade. But I think also because you've got, this is my supposition, the fact that investment demand is so very strong, and you probably should ask this maybe more to a refiner than me, but given that the premiums I could secure by producing, say, 100, a 5 ounce, a silver kilo, whatever, are just so eye-watering, you have that, I think, competition for what you can produce. So given you've only got, yes, you've got these tremendous above ground stocks, that's fine, but you have obviously that, the bottleneck of the refiner. They have only so much capacity, and if I can produce that and the demand is just so very, very strong, I would suggest that maybe is a factor just to roll into that mix as well.
Yeah, that's generally what I've been getting and arriving at, but I keep thinking there must be something else, which perhaps there isn't. And by the way, I would also support exactly what Mark said earlier about the CPAs coming in, and there's ample institutional potential sell.
Yeah.
Even if the market is tight. I agree with that entirely.
Excuse me. Do you see the investment in virtual assets affecting the investment in gold and silver as a replacement?
Well, I guess the wider question there is you could probably include, well, not wider, but part of that, of course, what's happening in Bitcoin and so on. I would say, yes, there is a portion of that which is being, say, harvested and they're not going to gold and silver. But I would still view that some of that is quite speculative, and that's, I think, where it can be quite concentrated. And I think from terms of, as a safe haven, I think that argues so strongly to gold and silver that I still see that being sort of very prevalent and not really losing that role whatsoever.
So I'm still struggling a bit with your price forecast. We just came off a year of supply-demand deficit. You're forecasting more deficits going forward.
Mm-hmm.
That would normally imply higher prices. So what is the driver behind your forecast for lower prices?
Well, I think the first point, the key takeaway is that, yes, we have a deficit last year and a deficit this year. But as I said, we used to put those into that context that even combined, you've got about, what do we have? Is it 120 million ounces or so in those 2 years? 120, 130. But that's out of combined demand of 2 billion ounces. So it's a very small figure, even though directionally it's important and is an important change in the marketplace. We've also got to put it into context that in Metals Focus series alone, the number of years that we have seen a surplus, and those years we've seen deficit, the deficit is very small. So we can't really look at that 2021 or 2022 figure in isolation. We've got to roll it up with those numbers of surpluses that we've had before that, which I think reduces the impact that it can have in the market. But ultimately, as I said, a 70 million ounce deficit out of a billion ounce of demand. So I think we just need to put that into that context. But as I said, you can have these different dynamics. As Jim was saying, you've got these massive premiums on 4.9 silver, so demand is exceptionally strong. You've got premiums on investment products at levels we've never seen for so consistently. So you have those, a really strong physical backdrop in all sorts of different places. Industrial on one hand, coin and bar demand in the other. You've got pinch points elsewhere. You've got India coming back. In 2020, no silver was going into India. And in fact, early 21, silver was coming out of India into London. So you've got all of these pinch points all over the place. And yet, from a price driver standpoint, in our humble opinion, in terms of the upside, it's more about what institutional investors, their activity. When we think about physical demand, that plays from a price action standpoint, that's much more important in providing that support to the price, that floor to the price. In our humble view, that will sort of rarely drive prices that much higher. We saw that for a little bit in the Reddit, but we did have a combination at that point of, yes, that was retail driven, but there was certainly, I would suggest to you, some hedge funds that were looking at that. Could they drive prices higher? So it was a mixture of investors coming into the market where we had that spike in the price. But when we're thinking about the price action going forward, I would say to you it's much more about the institutional investor behavior. And that's why you can have that different dichotomy in the market. Institutional investors responding to the changing macro backdrop, which may become slightly unfavorable from their point of view to holding silver, but still have very strong physical demand at the same time.
So if I could translate. Sorry. So you're saying that silver is likely going to come out of above ground stocks, probably from investor hands, and probably because of the forecast rate increases at the Fed? Is that the reason why we're going to see lower prices?
Yeah, what you'll have is, so initially in this current tight market where we are now, literally now, we have very strong demand all over. So institutional investment, to maintain these prices where they are, be it gold or silver, you've got to have strong investment that we're seeing now. So that would imply that you're having a stock depletion at some point. As we move, say, to the back end of this year, even crystal ball gazing into, say, 2023, the deficit that we have in our humble view that we think they'll have will be more easily met by selling by investors.
So just one last point on this. If we accept the Fed's going to raise rates, which they are clearly doing, for us to have lower prices, doesn't it imply that your assumption on inflation is that it's going to fall precipitously? In fact, fall below the Fed rate eventually?
I think it doesn't have to necessarily fall to that extent, but I think you can, by the end of this year, be on a, say, a declining trend, moving away from some of the figures you've seen, and therefore you're seeing the trend in real rates rising. So again, it's about both the actual as well as expectations of it as well.
So the contrarian would say that, sure, the Fed's going to get to 2% plus, but is inflation really going to get down to 2%?
No, I don't.
Negative?
No, again, I don't think it necessarily gets down to that level. But again, you can, as I said, you can have as I said, a correction in energy prices. Given that inflation is sort of an anniversary of prices, you can necessarily see, as I said, it's about the trend moving towards the back end of this year and into next year as well. So are we going to get down to those inflation rates by the end of this year? I think I would be shocked. Utterly shocked to see that. There's no, gosh, no. So that wouldn't be in our base case, or frankly, in any of our scenarios. But again, it comes down to the expectations of what investors are looking at, looking ahead.
But isn't it reasonable to assume that we're going to see the Fed rate at 2% plus, but we're not in the next several years, we're not going to see inflation at 2% minus. So there'll still be negative real rates, which will change the whole investment thesis. And I think the computer trading will come back on board.
Look, I mean, even the Federal Reserve doesn't have it in their FOMC forecast. They're talking 4.6 PCE core, and then 2.8 or 2.6. And so we're going to have inflation at above target for foreseeable future. And you're right, depending, but we're not calculating real rates based on reality. We're calculating what the market is projecting to be in the break-evens. And in the break-evens on the 10-year, in the 10s, we're very close now to having
flat.
real rates greater than zero. I haven't looked today, but inflation expectations have kind of flattened. Rates are moving up at the nominal side of the curve. And that's what the market is pricing. Now, the market could be spectacularly wrong. When I look at it, I look at those monetary conditions based on the short end. And that one is still the most accommodated it has ever been, even in the post-Volcker era. So, but that's how the market is behaving now, and it will continue until it stops.
Thank you.
One more question.
I think there's too many pieces to this market that it's hard to understand. Right? So while we're looking at inflation being high, I think you do have the investors that go, and Bullard said yesterday, they want to get to potentially get to 3.5% this year, and don't count out a 75 basis point increase. So then we get investors that go, what does this mean? What's going to happen? You could also argue, some people say, hey, and I'm cerebral, but you could argue that some people say, well, a lot of the inflation is built into it already, because the market has foreseen this inflation for quite some time. Then you can say to yourself, well, what happens if the Fed gets us into a recession? This question is whether they do or don't. And what happens with $100 oil and higher gas prices to the lower income people in this country? They get crushed. Our economy doesn't do very well. A lot of those electronics we're buying stop to get purchased, and that affects one part of the market. And then those investors go, wait a second, what happens to silver? I don't know. Let's go to cash. Let's figure it out. Right? So while I think longer term there is a base case for silver going much higher, I kind of agree that I don't know what's going to happen in the next 12 months. I go to cash. And I can see that's why we tail off a little bit this year. But I could also see us at $35 silver, and I think we can get there. I just don't know if it's this year.
All right. First of all, thank you to the presenters. Thanks to everyone for attending today. We had a few questions from online, but they've been asked through the audience here. So again, thank you everybody for attending. We do have some extra copies of the survey if you'd like to take some back to your colleagues. And thank you very much, especially those sponsors and institute members who are not only online but present here. Thank you for a very great morning. Thank you.
Well done.